Is it time for an S Corp? Is the S Corporation better than, let's say, the sole proprietorship? Or is it better than the single member LLC? Or really, is it even better than the C Corporation as really the taxation choice for you? Hey there, my name is Kenner French. I'm with vastsolutionsgroup.com, and we do specifically tax, finance, and artificial intelligence for entrepreneurs to help lower their tax liability while helping to increase their retirement income. In sum, we're a resource for small business owners, really micro business owners, as it were. In this video, we're going to explore the tax deduction advantages and disadvantages of the S Corporation. In fact, we just saved a client over $70,000 by helping him by using a strategy utilizing the S Corp. First, what is an S Corporation, or as it's commonly referred to as a S Corp? The S Corporation, it's a creature of the federal tax law, wherein you first form a corporation or a LLC and then elect the S corporation via the IRS. Thus, your legal entity is a corporation, let's say, or an LLC, but is taxed as an S corp. For federal tax purposes, your S corp is a pass-through entity, meaning the corporation's income, deductions, and tax credit items are passed through to you, the shareholder, on what's called a Schedule K1, referred to as a K1 commonly. For some business owners, this is the best of both worlds. You get liability protection with also personal taxation. What are the special rules relating to S corps? Everyone asks us that. To elect an S corp, the LLC or corporation, it must be the following. It must be a domestic corporation, including an LLC which can file as an S corp without having to formally file the check the box election. Number 2, you must have 100 or fewer shareholders. Number 3, have no shareholders other than U.S. citizens, individuals, resident age individuals, certain types of trusts, and certain types of, let's say, tax-exempt entities. And by the way, you can only have one class of stock. If your LLC or corporation violates any of the above, what happens? It loses the S Corp status, potentially not a good thing. The good news is that one owner or husband and wife owned business, your odds of having a problem with an S Corp election rules, they're totally insignificant. You're not going to have an issue generally. The real question is, does your choice of entity as an S corp put more tax in your, or more after-tax assets in your pocket? Let's get to the advantages and disadvantages of S corps. As with all operating entities, you will find advantages and disadvantages. But as you know from many of the videos we've done, well, there are just a number of ways of looking at the specific entity as to which one works for you on an after-tax basis. Well, that sure way is to do a numbers check where you identify the cash advantage or disadvantage of what causes the difference. You should do this before forming an S corp. Really think it through, and then every, let's say, five years, really determine if the situation still is in your favor or not. In general, the S corporation has 3 basic advantages, and yes, there are some disadvantages to ponder as well. Advantage number 1, you save on payroll taxes. When you operate your business as an S corp, you're both the corporate employee and a shareholder. As an employee, you receive a wage or a salary to compensate you for work that you are performing. As a shareholder, you receive distributions, think corporate dividends, sometimes we call them, to reward you for your intelligent investment decisions in your S corp. Your wage or salary incurs the FICA and Medicare tax and earnings up to a certain dollar amount. For earnings in excess of that, your wage or salary, you incur a Medicare tax in that only. The Medicare tax right now is 1.45, and it applies once your salary or wage exceeds a certain amount. Now that you know the payroll taxes, you can look at really the strategy of lowering your wages within allowable amounts, by the way, and increasing your distribution because lower wages reduce payroll taxes. Let's use an example. Say that before you consider your salary, your S corp earns a net income of $100,000. If you take the $100,000 of salary, you and your corporation pay at least about 13% in payroll taxes. Let's say you take a $38,000 amount as a salary plus a profit distribution. Presto. You and the corporation will save a considerable amount on payroll taxes. Of course, the payroll tax depends on a number of things, but just remember, it's got to be reasonable. Let's look at another example. Say the S corporation income before your salary is, let's just say it's $200,000. By giving you a salary of, let's say, $120,000 and a distribution of $80,000, your corporation will save about $2,300 in payroll taxes. Your savings here are in a far lower rate because you save on the Medicare tax only. Thus, with respect to the strategy of lowering your salary, answer these two questions now. How much do you save in overall payroll taxes? Can you justify the lower salary is actually reasonable? If the answer to both those questions is yes and the savings are substantial, then the S corporation is the choice that you should be making without a doubt. Advantage number 2, split taxable income. The strategy might be for you if you gift money to a person who's in a lower tax bracket than you, and that person is not your child, who can trigger the kiddie tax. We can go into that specifics later. Here's how this works. Say you're in let's say the 37% tax bracket, and you want to move some money to, let's just say, your dad, as an example, who is in, let's just say, just for figurative purposes, 10% tax, being very, very simple and illustrative here. If you want your dad to have, let's say, $10,000 in his pocket, you have to either earn $15,000 roughly and pay taxes on $5,300, etc., and then gift the remaining $10,000 to your dad. Or you can give your dad a percentage ownership in your S corp, so the corporation can distribute money to him on which he would pay about $1,100 in taxes, leaving him with $10,000. Note, you had to earn $4,200 more to make a gift with your after-tax money compared to gifting percentage of your S corp. Your father, 15,000 minus roughly 11,000. The downside to this strategy is now that your father owns part of the corporation, how do you get it back? Well, it's highly probable that you will inherit the stock when your dad passes. By the way, sorry for mentioning that. But it's obvious that you need to at least think about this, because on an after-tax basis, it can make sense. Now, how about your children? I mentioned the kiddie tax. It destroys the income splitting strategy for children who are under the age of 19 or who are under the age of 24 and in college. Because of these children, the law taxes unearned income at the parents' rate generally. Advantage number 3, no double taxation. You no doubt cringe when you hear the words double taxation. But here's the good news. Double taxation isn't what it used to be back in the day, because corporate dividends are taxed at a different rate, that being 15%, generally speaking now. Now, remember, I'm saying generally speaking, worth noting, right? Thus, the C corporation income of $50,000 or less, your combined corporate and individual rate is only, let's just say it's 27.5%, or roughly. But as you do not have a 15% tax bracket if you operate as a personal service corporation. In these cases, you face a corporate tax hit and then pay the 15% dividend rate. Also, once your income and dividends exceed the first corporate tax bracket of $50,000, the effective tax rate jumps. It should be noted that all these figures that I'm talking about are quite dependent upon the circumstance. To wit, all these specifics are variable on the year, the tax bracket, etc. These figures should be really thought of as illustrative. Really, they're very simplistic for purposes of understanding this further. Some of the facts and figures, I should note, are provided by Bradford Tax Institute at Industry Resource. When you combine the various factors, it's likely the S corp avoids the double taxation you would face with a C corporation. As mentioned earlier, to find the after-tax benefit of choosing the S corp over another choice of entity, you need to consider 3 advantages mentioned earlier and the few disadvantages that I'll mention right now. Disadvantage number 1, extra tax return and legal fees. Unlike the Form 1040 Schedule C of a proprietorship or sole prop, the S corporation tax return includes a balance sheet in addition to the required K1 pass-through information. To ensure that you get the numbers right in the right spots for the S corp return, etc., you should use a professional tax advisor. Your corporation is a corporation, and that means you also need corporate paperwork. Sorry to have to bring that news to you. To get this right for both tax purposes and legal protection, you should use a professional. Thus, the first disadvantage of choosing the S Corp rather than the proprietorship is the extra cost of the returns and corporate compliance. Disadvantage number 2, possible extra state income, franchise, or similar taxes. Depending on where you live, your state may require your S Corp to file and pay a state income, franchise, or similar tax, depending. This can seem unfair when the states levy an additional tax on the S Corp does not generate an offsetting deduction for you on your personal taxes. I know, I get it. Disadvantage number 3, extra paperwork. Yep, that sucks. What can I say? The balance sheet I mentioned in disadvantage number 1 creates extra paperwork on your part. In many cases, this makes double entry bookkeeping more appropriate, and that's harder than simply keeping your checkbook or Quicken, let's say. The S Corp also creates extra tax-related paperwork each time you take money or another asset out of the corporation, because you must treat each withdrawal in one of really 3 ways. Number 1, as a salary or bonus paid to you in your capacity as a corporate employee, as a distribution or corporate earnings paid to you in your capacity as a corporate shareholder, or finally number 3, as proceeds from a loan made by the corporation to you. If you treat the withdrawal as a salary or bonus, you'll have to deal with the employment taxes, employment tax forms, and W-2s, etc. Distributions create adjustments in the retained earnings section of your balance sheet. Now, loans create a need for loan documents and interest rate, and preferably a repayment schedule backed up by actual payments on your part. Comparatively, you face little extra tax-related paperwork when you run your business or practice as a single-member LLC or proprietorship. Now to summarize, as you probably already hear, the choice of moving to an S Corp really depends upon your specific situation. Think it through. Talk to a professional. In the end, you may be quite happy that you did just that. There are disadvantages, as I mentioned, believe me. But at the end of the day, from a tax standpoint, you may be much, much better off with an S Corp depending on the factors that I mentioned. Once again, my name is Kenneth French of vastsolutionsgroup.com. It has indeed been a pleasure discussing the elements involving S Corps. I should note, we specifically do not practice law in our entity. Our company has entity attorneys, planners, and tax strategy groups that deal with such matters. If you have any questions, call us. Our number is 888-808-8278. Alternatively, go to our website at vastsolutionsgroup.com. Again,